Good morning, treasurers. This is your host Chandrakant Sharma from Night Fintech, and you are listening to Night Snippets. Let's discuss the economic news which happened this week. This week, many crucial data and events occurred which provided direction to the major markets. During the week, FOMC decided to keep the rate of interest unchanged at 5.25%. The rate decision was in line with the market expectations. Out of the 18 policymakers, 12 voted for rates at or above the range of 5.5 to 5.75%. It means most policymakers agree that further tightening is needed to contain price pressures and to bring inflation to its 2% objective. Fed signaled chances of 2 rate hikes during this year itself. The United States CPI numbers for the month of May were released at 4% against 4.9% inflation for April month. Since June 2022, the inflation has continuously decreased every month. If the inflation will decrease further during June, Fed may again keep rates unchanged during next FOMC, which is scheduled on 25th and 26th of July. US core retail sales month over month increased by 0.1%. US producer price index month over month decreased by 0.3% during May month. PPI measures change in input prices of raw, semi-finished or finished goods and services. If input costs rise, some will be absorbed by the producer and some will be passed on to the consumer, thereby contributing to the inflation. Regarding European countries, France CPI decreased to 5.1% for May month as compared to 5.9% for the month of April. Similarly, German's inflation month over month decreased by 0.1%. Germany, the fourth largest world economy, has already declared recession after the country's GDP recorded its second quarterly contraction. In United Kingdom, the unemployment rate came in at 3.8% in April 2023. If we talk about the remuneration, the wages excluding bonuses were 7.2% higher than a previous year during April against forecast of 6.9%. This is one of the largest increase seen after COVID. It indicates chances of wage price spiral. The European Central Bank lifted interest rates by another 25 basis points on June 15, raising the borrowing costs to their highest level in 22 years to 3.5% and left the possibility for more hikes, extending its fight against high inflation. In global economies, China cannot be left out. The industrial production in China slowed down to increase at 3.5% during May as against increase of 5.6% during April. Unemployment in China remained at 5.2%. Night Insights. The fear of inflation seems to have reduced during last 2 to 3 months. The CPI number of US, India and other major economies has come down due to the efficiency of the measures taken. Inflation in France as well as in Germany has also come down. Although the CPI in UK is still above 8% mark. In US, Fed has kept rate unchanged but shall take further actions during the next month FOMC after considering the economic data. Due to expectations of control over inflation in long term, the US Treasury yield curve has inverted more. The US 10-year closed the week at 3.77% and US 2-year closed at 4.72%. Last year, for the first time, filings for unemployment benefits reached 2.62 lakh, marking the highest level for weekly claims since October 2021. Any further increase in unemployment can restrict the yields moving up. We expect 10-year benchmark yield to remain in between 3.60 to 3.81% level. Regarding crude oil market, during the week, Brent oil dived to $71.63 level but recovered to close the week at $76.26 mark. Crude oil fell during the week due to concerns over demand growth and rising supply. India and China both has emerged as countries importing around 80% of Russian supply. The oil got support near $71.60 level for the fourth time. Weak Chinese industrial production growth weigh on oil prices. Oil prices recovered after China lowered short-term interest rates from 2% to 1.9%, supporting growth. In absence of fresh demand, we expect oil prices to remain below $77 and can retest $71 support mark. On currency front, dollar index fell from 103.5 level to close the week at 102.30. Status quo in Fed meeting pushed dollar index down. Fall in US inflation to 4% level along with rate hike by European Central Bank also weakened dollar. We expect dollar index to remain in 101 to 103 range for this week. USD INR closed week at 81.93 after weakening of dollar index. Indian economy is doing well on all fronts. Further weakening in dollar index can strengthen Indian rupee to 81.50 level. The USD can be sold near 82.20 level. Domestic debt market, the benchmark 7.26% 2033 bond yield closed at 7.03%. As expected in last week's Night Insights, the domestic market is comfortable near 7% yield. On Friday, the yield touched 3-week high of 7.057% level but fell as buying came at lucrative levels. The Reserve Bank of India set the coupon on the new 2053 bond at 7.30%. The 1-year swap rate settled at 6.66%, almost at same rate of previous week close of 6.65%. The 5-year overnight index swap rate ended at 6.15%. Night Insights. According to the borrowing plan for April to September, the government will sell 1.69 trillion rupees worth of gilts in June. This is the highest monthly issuance in 2023-24 so far. This has increased supply, thereby forcing prices down and yields up. The global economic data and inflation figures are indicating on soothing inflation, which can keep global yields down in upcoming week. For upcoming week, we expect 10-year yield to trade in 6.99% to 7.06% range. Near 7.05%, the bonds can be bought. That's it for the week. See you next week with the new episode from Night Snippets.